Good evening, ladies and gentlemen. Welcome to another webinar of MeritorQ Advisory Portfolio. I am Alok Nangalia and I am part of the Client Advisory and Relationships team. I have with me Krishnan, who heads the research function for our quant offering and manages the MeritorQ Advisory strategy. The agenda for today's webinar is to share our thoughts around value of free cash flows. We believe a business is worth only the present value of its future cash flows, not the present value of its future earnings. In MeritorQ, value is measured by comparing the free cash flow generation ability of the company versus its market capitalization, a valuation measure known as price to free cash flows. Today, Krishnan will help us understand two things. One, why doesn't Marcellus focus first and foremost, as many other investors do, on earnings or earnings per share or earnings growth? Second, how price to free cash flow is superior to other commonly used relative valuation measures like PE and some other ratios. As usual, this will be followed by Q&A session. You can type in your questions in the box on your screen during the course of this webinar, and we will try and answer as many as possible. With this, I request Krishnan to take us through the presentation and help us understand the value of free cash flows. Over to you, Krishnan.
Thank you so much, Alok. Again, good evening to everyone. And it has been now almost 2 months where we, from our last webinar. Unfortunately, the reason why we didn't have the webinar for the last 2 months is, again, because there's an advisory business, and we were facing some new regulations regarding how we present or communicate to clients. So we had to adjust ourselves. So that's the reason. Again, we have we kind of took a break over the last 2 months, and now we are back, right? So before I move on, just some disclosures on generally about what we are going to speak on today. So firstly, do note that these investment securities are subject to market risks, and you should read all scheme-related documents carefully before investing. And also all the figures we will discuss today, either in terms of return numbers, they do not guarantee any future returns, obviously. And the securities, if we mention, they are only for illustratory purposes and not for they're not recommendatory, right? So please note these disclaimers, for today's presentation. Maybe a quick overview on the product. MeritorQ can be accessed through small case. If you remember, we have made this product now. The pricing is, it's fixed. It is 20,000 per annum before GST, paid quarterly. The minimum ticket size is now 2 lakhs. It's around 2 lakhs. You'll be able to find the exact minimum ticket size when you go and access the product on small case. And we also have a systematic investment plan which is available to subscribers once you have invested the minimum amount, the minimum initial investment amount. So with that, just moving on, to what we have discussed till now, because you have taken this 2-month break. So, maybe for benefit of, for both, again, people who have joined us for the first time, and even, people who have listened to us earlier, just a quick recap. What we are doing here in MeritorQ, first of all, it's a rules-based strategy or a quant strategy, right? I.e., we follow a set of rules to create the portfolio. And what you see on the slide is those rules, right? So firstly, the investment universe we start with is the BSE 500 or the NSE 500, basically the top 500 companies in India, large, mid, and small cap companies. From here, we weed out companies which don't have clean accounts per our forensic accounting framework. We also remove companies with high financial leverage, and also those with inconsistent. We don't have a track record of consistent profitability. And again, the primary function of all these screening steps is to reduce the overall risk in the portfolio, right? Again, we have explained the rationale for all these steps in more detail if you go back and check our previous webinars. So I won't get into details here, But once we do that, from starting from those 500 companies, after we apply the screening steps, we are left with around 80 to 100 companies. And from here, we select companies into the final portfolio. We select around 30 companies in the final portfolio, basis both profitability as well as relative value. Relative values, again, basis the price to free cash flow metric, which we will discuss in more detail today. Finally, once we create the final portfolio in MeritorQ, the allocations are decided basis the extent of their of a company's overvaluation or undervaluation, right? So it's basically basis the price to free cash flow metric. So that is how it works. We repeat this whole process twice in a year as of the first trading date of April and October. So the rebalancing date is completely fixed. We also have a manual corporate governance check at the very end, and we have talked about this in length in our previous webinar. So again, I won't get into the details here, but we basically go through this series of steps, right? And these steps or this portfolio construction steps, or what we call as the investment checklist for us, is what we follow every rebalancing, again, without exceptions, right? So this is a completely rules based, and we just stick to this set of rules, any difference in the market environment, anything that changes, doesn't our rules don't change. Okay, now we also wanted to, again, just touching about this, this aspect of how this different rules contribute to the overall returns. So what we have done here is just broken it down. Again, many of you would be aware, or would already have seen this slide. But just to recap, right, what we are showing you here is all the rules on the left. And on the right section, we are showing you how much each of these steps have contributed in terms of your overall returns, which is your first column, on the right section, and then the risk-adjusted return, and also you can also see the number of stocks, which is your very last column, right? So the forensic screen obviously is the most important, the most significant, value add step to your overall returns of the strategy, right? So it adds, as you can see, roughly around 4.9% to your the overall 3-year. If you look at the 3-year rolling returns of the strategy, it goes from 7.9 to 12.8, right? And reduction in risk and improvement in return, so the risk adjusted return goes up by almost 0.25, right? Now the subject of today's webinar being the we are going to focus on this price to free cash flow metric, right? What we call what we can think of as a relative valuation metric. Now that comes into play in the selection step, right? So like I said in the previous slide, we select companies which are both profitable as well as undervalued. Undervalued is measured using price to free cash flow, right? So that comes in the selection step, and it also is used in the position sizing of the final portfolio, right? So the selection step, here you can see, just the the very fact, the step of adding, selecting stocks which are both profitable and undervalued, roughly adds around 2.6 percentage points to the overall return of the strategy, and the risk-adjusted return also goes up another 0.25. So again, your risk-adjusted return improves. So you're getting more returns per unit of risk, which is ideally what all investors should aspire for. Now, again, when we are stating these returns, do remember these returns are calculated on in price terms. They do not include the impact of dividends. So we're not considering any reinvestment of dividends. And they're also stated on the gross basis. So they do not include fees or any other transaction cost. So, just maybe delving a bit deeper on, why we are, talking about, this price to free cash flow today, why it is, so the subject of today's webinar is why is the price to free cash flow is our preferred valuation metric, right? And why is it used in MeritorQ? So what we will do is we will split up this discussion into 2 halves, right? In the first half, we will discuss on why price to free cash flow is superior to some other commonly used relative valuation measures like price to earning or an enterprise value to EBITDA, right? Or a price to book, especially in Indian context. And then in the second half, we will also talk about some advantages of using this price to free cash flow as a valuation metric, how it helps investors generally and more specifically in MeritorQ. Okay, so before we get into this, how what is the impact of using price to free cash flow, and generally, right, how it compares to other valuation metrics. It's first of all, we just want to clarify, what we mean by free cash flows, right? So when we say free cash flows, which is your denominator in your price to free cash flow, ratio. Free cash flow is basically the leftover cash available to both debt to equity holders of a company after it has paid its operating expenses. So when we say operating expenses, nearly all expenses, right? So your cost of your daily operations, your sales expenses, your advertisement expenses, and all other kind of power expenses, so on and so forth, right? Fixed and variable expenses. And also your taxes, and also your long-term investments, right? When I say long-term investments, either it's capital expenditures, for example, you're putting up a new plant, right? The expenditure incurred in putting up that new plant, or you are spending in in terms of your working capital investments. Those would also be included in your free cash flows. Right, and also remember this free cash flow. We are also considering other things like, for example, merger, acquisitions made by the company. So that is also included in this, right? So essentially, this is this free cash flow, includes all the expense items, which typically the management has to take a call on, right? Essentially, it's like it is a very good metric to look at. If you want to look at a capital allocation skills of the management, right? Because depending on how much the management wants to spend across all these different line items, will determine again its free cash flow, and it will be reflected in the free cash flow generation of the company, right? So what does this flow chart in the bottom of the slide this shows is how does free cash flow kind of stack up when you compare it to some of starting from the assets of the company, right? So firstly, earnings are the profit after taxes. So basically, they are the revenues net of operating expenses and taxes, right? And earnings come from sales, and sales themselves are generated by sweating the assets of the company, right, or utilizing the assets of the company. So you start from the assets of the company, which is in a way for equity holders that is represented by the book value of the equity of the company, and then that gets translated into the sales, right? So the equity holders put in company, they put in their money into the company, they start generating revenue, and then depending on the operating expense of the company, the earnings get generated. And then you come to the cash flow. So cash flows are, again, all the items, after earnings, for example, adjustment for non-cash expenses, and also adjustment for working capital, as well as capital expenditures, all the other long-term investments like capex, M&A, whatnot, right? And again, remember that cash flows adjust for all non-cash items like depreciation, amortizations, whatnot, right? So cash flow in a way is, like they say, cash is king, right? So cash flow in a way is the reality, right? So if you think about any metric that which gives a fair idea on the profitability of the company, the capital allocation skills of the management, it is free cash flows, right? So with all this, right, whatever we have on this slide, one question on your mind, and this is what Alok also introduced this webinar with, why doesn't Marcellus, or even us as a team, or even here in MeritorQ, why don't we look at earnings or earnings per share, right? Which is what majority of the market participants look at. The simple answer is, when you think about the value of any business, right, especially to equity holders, the value of a business is the present value of all its future free cash flows, right? Which is a very important difference, right? It is the present value of its future free cash flows. It is not the present value of its future earnings, right? So that is why free cash flows, the generation of free cash flows, the sustenance of this free cash flow, and how much the business is able to grow and sustain its free cash flow determines the value of the business, right? And it's fundamental to the both the business of the company and how you value the business of a company. So moving on. So let's take maybe another 1 minute to review how price to free cash flow and some of the other common valuation ratios are calculated. So this is what we are trying to show on this slide. Price to book is basically calculated as your share price. So it's basically a ratio of your share price by your book value of equity, the same book value of equity. So it's basically the book, all the capital that is invested by the shareholders of the company, right? So it's basically that ratio, right? So it tells you, how much the share price of the company compares to the original capital that was contributed by the both by the original shareholders as well as the capital or the the profits that was reinvested by the company into its own business, right? Net of dividends. Similarly, price to earnings is calculated as a ratio of your price to your latest earnings per share, right? So you've considered obviously the historical or your latest earnings per share. There are other definitions of people use the forward or the forecasted earnings per share, or they might use a trailing 5-year average or whatever. So again, at least in this case, at least for the comparison purposes in some of the later slides, for at least for this presentation, we have considered the last reported earnings per share of the company, right, while calculating your price to earnings. Price to cash flow is, in our case, is defined as the enterprise value of the company, right, which is basically the total value of a company, if you think about it, which an acquirer will pay. So essentially, it is your, simply put, it's your, the debt and the equity of the company with the cash, the free cash taken out, right? So that is what an acquirer will typically pay for the assets of the company, right? So that divided by the free cash flows, the way we define free cash flows in the previous slide. So this is how we define price to free cash flow in the strategy, and also when we refer to price to free cash flow subsequently in all other slides today. Now, when you think about valuation ratios, it is important to keep in mind that the lower the better, right? So if you're looking at, so if you're typically if you're as investors, you want to buy a company, typically you want to buy something that is cheap, obviously controlling for many other things, obviously quality, but obviously you want to pay as less as possible for, say, for example, the next 5 years of earning, or the future earnings, or the future cash flow, or the book value of the company, or the asset base of the company, right? So typically you want this ratio to be as low as possible. So the other way to understand this is, this valuation ratios can be understood as a payback period to the investors after making the initial investment, right? So shorter the payback period, the more undervalued the company is, right? The lower is better. So for example, if a company is bought when the price to free cash flow is 10 times, then the debt and the equity holders of the company can be paid back to the current free cash flow generated by the company within, say, 10 years, roughly, right? So that's what it means. So all things equal, you would prefer a shorter payback period, i.e., a lower price to free cash flow or any valuation ratio. And obviously, the lower any valuation ratio is, the more relatively undervalued that company is. Okay, so maybe just moving on. So this is the this slide shows you the analysis which we did on all non-financial service on all non-financials in BSE 500. So essentially, that is around 420 to 430 companies on an average, right? So you remove all companies which are in the financial sector, right? The reason why we did that is for, if you are looking to, see results, how price to free cash flow or selecting based on price to free cash flow is effective or not. Obviously, free cash flow has no meaning for a financial company or a lender, simply because there is no concept of a working capital, right? Because this generally tends to be service businesses, right? Secondly, there's no concept of a capital expenditure. They don't have to put up a plant, right? Or they don't have to manufacture some widget or etc. So there's no concept of a tangible asset also, right? So there is no concept of a capital expenditure for these companies. So that's why free cash flows is not a relevant metric for financials. That's the reason we have not considered financials in this analysis, right? But do note that in MeritorQ, it doesn't mean that in the strategy or in MeritorQ we exclude financials. No, we don't. In MeritorQ, financials are selected basis price to book, and like you said, the profitability for financials is measured using return on equity, whereas the relative valuation is measured using price to book. Just to emphasize that point, even though in all the analysis which we will show subsequently, and everything that we will discuss today is probably relevant to only non-financials, it does not mean that we are excluding financials in MeritorQ. We will probably have a session at some other point in time where we will talk about why we chose price to book for financials in greater detail. So just moving on. So another thing to notice when we use these valuation ratios, like price to free cash flow, because some companies could have negative earnings or negative free cash flow. Using a price to free cash flow is not very meaningful. So when we create these portfolios or these buckets, we generally use the inverse, right? So that's just to be clear on the terminology. So what we have done is we have taken all non-financial companies in BSE 500, like I said, it's around 420 to 430 companies, and we have divided into 5 equal size buckets, right? So roughly each bucket would have, say, around 80 to 82 companies, 80 to 85 companies roughly. And each of these buckets, what we have then done is, so the bottommost bucket, the Q1, is the most expensive bucket measured using price to free cash flow. That is, it has the highest price to free cash flow. Q5 or quintile 5 is your cheapest, has the cheapest companies by price to free cash flow. So it has the lowest price to free cash flow, right? So this is how we have built this portfolio. Now, what we do is we do this selection every year in September, right? Using price to free cash flow, and then we categorize company into all these 5 quintiles, and then we repeat this process every year annually in September, right? So every year we get the free cash flow of the company basis their fiscal year end, the free cash, the cash flow numbers, and then we use the September end share price to calculate your price to free cash flow, or your, the way we calculate price to free cash flow, as we explained in the previous slide. And then we have seen how this portfolio created this way, and dividing it into all these 5 quintiles. What is the behavior, or what is the return of each of the quintiles, right? Which is what you see on this slide. So the price chart of each of the 5 quintiles is what you see on this chart, starting from July 2006 to September 2022, right? So what we are trying to say here is, if you had selected, right, basis price to free cash flow, price to free cash flows, and if you had selected only the bottom 20% in terms of price to free cash flow, which is your quintile 5, you would have realized a compounded annual growth rate of roughly around 16.3%, which is what you see, right? And if you had invested in the next 20% of companies by this price to free cash flow measure, you would have roughly realized 15.7%, again, compounded annual growth rate appreciation in your wealth over this 16-year period from July 2006 to September 22. Now, the key, why we are showing this to you is, as you go from your most expensive quintile, which is your quintile 1 to quintile 5, what you can see is the returns kind of go up in a linear fashion, right? So they increase, right? Which tells you that buying companies which are cheap or undervalued, basis the the free cash flows, it's a very effective tool to grow your wealth, right? So again, we will get into some of the other details in the next slide, but that's the key takeaway for you as you see the returns on this slide. And please note again that the returns shown here are gross of all fees, transaction costs, and the returns are calculated on basis price returns. And also please note again the disclaimer which I kind of started out with, that this is for the return figures are here for presentation purposes only and do not guarantee anything, not guarantee any future returns. So again, what we did is, we saw the returns, if we had, just selected the most expensive set of stocks, the bottom, the most expensive 20% stocks, or, the most cheapest 20% stock. Obviously the cheapest 20%, bet, completely outperformed your, the most expensive 20%. But what we are trying to show on this slide is what is the fundamental characteristics of each of this quintile. So we've chosen three ratios or three metrics, right? So one is the return on capital employed, which tells you about the profitability. Then the debt to equity, which tells you about the financial leverage, and the obviously the price to free cash flow, or the inverse of the price to free cash flow, what we call as the free cash flow yield, right? So what you see here is in the as you go from Q1 to Q5, your free cash flow. So first of all, you can observe that quintile 1, the free cash flows or the free cash flow yield is negative, because that's mostly companies which have negative free cash flow, right? So they are the most expensive in some ways, right? So if you are buying companies with negative free cash flow, in some ways you would say that is the most overvalued companies I'm buying, right? Next, as you go from Q1 to Q5, you can see that your, the free cash flow yield is increasing, i.e., your the price to free cash flow is going down, right? So Q1 and Q2 again, on an average, these the stocks in this in this two quintiles are mostly negative free cash flows. Starting from Q3, you can see that the free cash flow yield turns positive. And of course, it's the highest for Q5, right? Because you're creating this portfolio based on price to free cash flow. So there's no surprise that, again, as you go from Q1 to Q5, your the inverse of your price to free cash flow, which is free cash flow yield, that will increase, right? So there's no surprise there. But what is surprising is, as you see the profitability as well as the debt to equity across these quintiles, right? So one thing is, and one thing that comes out very clearly is, across, especially as your, the free cash flow yield increases, right? What you see is the ROCE is becoming better, right? So the profitability of these companies is also becoming better, right? So think about it, right? As your free cash flow generation is improving, starting from Q3, you can see that the ROCE is now going from 9% to 16% into 23 and into 27, right? This is not a surprising outcome. The reason is, if you think about it, free cash flow, like I said, right, it is all encompassing, right? It takes into account the capital allocation skill of the management. Because it includes net working capital, it also tells you how efficient the company is in terms of sweating its assets, right? In terms of managing its inventory, right? Managing its account receivable, right? In terms of its asset turnover, right? So it tells you the efficiency bit, right? All of which is also considered in your return on capital employed, right? So if the company, for example, is more profitable, that should also reflect in your in terms of your higher free cash flows, right? So again, no surprise that as your free cash flow yield increases, so free cash flow yield has free cash flow in the numerator, remember, right? Or your price to free cash flow is going down, your return on capital employed or your profitability also increases, right? Similarly, the other thing is the debt to equity of these companies on an average of, in each of the quintiles, that's also going down, right? Again, no surprise there, because you can think about it, right? These are if a company is generating a lot of free cash flows, it doesn't need external financing, right? So it doesn't need to raise debt, right? So the need for debt financing also comes down, right? So because the need of debt financing is less, you can see this practically in terms of lower debt to equity as you go from Q1 to Q5, right? The one surprising aspect is, and we have kind of marked this out, with this red box, is the quintile 4, right? So quintile 4, even though it is not the most undervalued quintile, right? So this is not the cheapest 20% of stocks basis price to free cash flow, right? But it has your highest profitability, right? And also has the lowest debt to equity compared to all other quintiles, right? Even though we cannot say it, but our guess is, and we have kind of repeated in the past, that again, buying companies simply basis a valuation measure, either price to free cash flow or any other valuation measure, is not a good strategy, right? Because just focus, because we are just focusing on one aspect, which is the price with respect to the fundamentals, right? And sometimes again, and this happens more frequently also, that invest, just investing basis relative valuation can expose you to value traps, right? So value traps are again companies which are justifiably undervalued because of weak fundamentals, right? So free cash flow, the price to free cash flow is not low because these companies are undervalued. It's low because the free cash flow of the company is now deteriorating, right? So it is not driven, the undervaluation is not driven because of the price, but because the fundamentals are deteriorating. So if you're buying just the Q5, right, without any regard to profitability, the risk is that you would end up holding these value traps, right? So what happens is, again, this is where I think, when we are thinking about a selection MeritorQ, we ended up selecting companies which are both profitable as well as undervalued, right? We are not only selecting companies which are undervalued, exactly for this reason, right? Firstly, we are screening out, again, all the, the aspects, the negative aspects on the company, whether it's clean accounts. We are only looking for companies with clean accounts, with with not too much leverage, with consistent profitability. And with all that, we are also saying that give me profitable companies which are undervalued, right? Which is essentially companies in your quintile 4, right? Which is undervalued bucket, but which are stocks which are also profitable. So you're avoiding value traps all the way, right? At the same time, you're getting full benefit of investing in companies which are undervalued with respect to their free cash flow generation ability. So just moving on. So this slide kind of again talks about again what, just continuing from what we saw for price to free cash flow, right? Dividing it into 5 buckets. Now, what we did is we did the same exercise for other relative valuation ratios, right? Like I said, we also wanted to compare, price to free cash flow versus, say, a price to earning, an enterprise value to EBITDA, or a price to book, which are again other commonly used valuation ratios. Again, what we did is exactly the same exercise. We took the all the non-financial companies in the BSE 500, and within that we just divided into 5 equal size bucket basis, say a price to free cash flow, or a price to earning, or a price to book, on enterprise value to EBITDA. And also what we did is we repeated this exercise on a universe which is screened for our forensics, right? So we again divided this into 5 buckets. So we did, so the red bars which you see here is on the the 500 on the all the non-financial company in BSE 500, whereas the blue bars which you see here is all the non-financial companies which have passed our forensic screen, right? So that's a difference. So we did both, right, just to be more thorough. So what you see here is the return spread, right? So what the y-axis is telling you is the return spread. So that this is the return spread between your most cheapest quintile, the cheapest 20% of stock, and the most expensive 20% of companies, right? Non-financial companies, right? And wider is this spread, right? Ideally, when you think about it, you're sorting basis or creating this quintile spaces, these metrics. Wider is the spread, the more effective you can say the particular ratio is in separating undervalued from overvalued companies, or more effective that ratio is as a true relative valuation measure, right? So so what you see here is when you do this, price to free cash flow obviously has the widest spread, right? So when you just the difference in returns between quintile 5 and quintile 1, just on the overall universe of non-financial universe is roughly around 13%, and it's around 4.4%, on the universe after forensic, gained after forensic. And for all other ratios, you can see that this this spread between your bottom and your the cheapest and expensive quintile, that is progressively is much lesser, right? So price to earnings, obviously it has 3.6% spread, but price to book is the worst, right? So it has the spread is negative 7%, and after forensics it's negative 2%, right? So the key takeaway again here is that price to free cash flow as a relative valuation metric is the most effective, right, in separating the overvalued and undervalued companies, even in terms of a relative valuation ratio, and kind of separating the wheat from the chaff, if you think about it, right? So yeah, I mean, if for example your question is why do your the blue bars here, why are they why is the dispersion in the blue bars, or the range of those blue bars lesser compared to the red bars, right? So you can consistently see this across all the ratios. The simple reason is once we have a screen for quality, right? So we are controlling for quality using all our forensic screen. Basically we are now looking at a subset of companies which already have clean accounts, right? So we are already controlling for one aspect of quality, right? So what happens is the downside risk of this of a forensic screened universe, that is lower, right? Drawdowns are also lower. So what that reflects in here is the returns. So for example, a price to book, if it had a spread of 7% on the overall non-financial universe, after when you look at the spread on or you sort stocks on price to book on the non-financial universe after forensics, the spread now the negative returns that comes down to 2%, right? So that's the reason the downside risk reduces, and the screened universe is much more stable, right? So that's the reason the range of these blue bars is lower, it's lesser than the red bars. Now, remember that the back-tested results, so essentially we talked about, whatever we have seen till now is between July 2006 to September 2022, when we have, back-tested the strategy using, again, the point-in-time data, and using the same set of, the rules which I described, right? Either, sorting it basis price to free cash flow or any of the valuation ratios, and we do this once in a year in September. Now, till now, we have assumed a 1-year holding period. So you create all these portfolios, say in September, you hold it till the next September, and then you rebalance it as of the first trading date of October, right? So essentially, the holding period is 1 year for all the portfolios and what you've discussed till now. Now, what we also wanted to show you is does price to free cash flow as a metric work when you increase the holding period of this portfolio in the back test, right? So again, this is a thought, almost like a thought experiment to to answer the question on, for example, many investors usually have this question that you're using all this relative valuation ratio, but is this are these ratios apt for long-term investing, right? Or are these aligned to a long-term investor, right? So the short answer is yes, and that is what we are trying to show on this slide. Here we are comparing the return spread, again across the most expensive 20% of stock and your the most cheapest 20% of stock. So this is Q5 minus Q1, which is what we are showing on your y-axis. And here we are saying on the x-axis, you see the holding period, right? As you increase your holding period from 1 year to 2 year to 3 year, 4 years, and then subsequently 5 years, what happens? So when I say a holding period of 3 years, essentially what I'm doing is in the backtest, I create one portfolio, say in the first period in September 2006, and then I let the portfolio, I see the portfolio performance for the next 3 years, right? And again, rebalance or sort it basis price to free cash flow again in September 2009, which is 3 years hence, right? And I keep on doing this once every 3 years over the backtest period, and that the average of all those numbers is what you see here, right? What we have done is we have shown these numbers for price to free cash flow. So, for example, 13.2% there tells you that the return spread between the expensive and the cheapest quintile when you sort it basis price to free cash flow on a non-financial universe, done basis price to free cash flow gives you 13.2% on an average with a 1 year holding period. This is the 13.2% which you would have also observed here. Observe the first red bar here, right? Because again, like I said, we were talking about 1 year holding period till now, right? And similarly, the 3.6% here for the 1 year holding period for price to earnings is similar to the 3.6% which you would observe for 3.6, the second red bar here, right? But the 13, as you go down to your 2 year holding period, 13.2 increases to 13.8, right? And subsequently to 11.4, 11.9. And obviously, as you increase your holding period, the signal as such, the free cash flow signal, that becomes outdated, right? So you can imagine, right? You created a set of quintile portfolios, in 1 year, and then you are refreshing it 5 years down the line. So what this tells you is price to free cash flow as a metric, it is able to distinguish between undervalued and overvalued stocks at least till over next 4 years, right? Whereas when you compare it for versus another metric like price to earning, first of all, the spreads are unimpressive, right? And it also decays much more faster. So this returns which you see, the spread between the most undervalued or overvalued in terms of price to earnings, that goes down from 3.6 to 2.6 when you look at it in terms of the return spread, and then it subsequently drops down to negative when you reach the 5th year, right? So the short answer is that to what we the question we started with the start of the slide is price to free cash flow. Yes, it is aligned to an investor who has a longer term horizon, right? And it is also better than some of the cruder relative valuation metrics like price to earnings, which other investors use. Okay, and now we come to the second half where we discuss some of the advantages of using price to free cash flow generally as a valuation ratio. The first advantage is, like I said, the free cash flows include all the operating and capital expenditures actually incurred by the company without any accounting related distortions. So they are more comparable across companies with different business models, right? So in many industries, what you see is, for example, there is a different accounting treatment for a depreciation, or they might be accounting for the capital expenditures in a different way, right? For example, let's take an example of consumer durables or a FMCG industry, right? So here for companies in FMCG, the main competitive advantage, right, is derived from or their moat in a way is derived from spending on advertisement, right, or promoting their product. And it's the spending on advertisement is a important launchpad for a company for its competitive advantage and also its future growth, right? While some advertising effort, you might argue, drive current sales such as in-store exhibits, the real value for any advertisement expenses these companies do comes from sustained campaigns aimed at brand building, right? So and this brand building is what is like the moat for the companies, these kind of companies. So unlike constructing factories or buying equipment, branding creates no tangible asset. So this and also this is not an asset which can be appraised or depreciated. So from a financial point of view, this is not a an asset which is there, right? But if you actually think about it, it is it is an expense nonetheless, right? It is money getting out of the door, on which the benefits are going to be which the benefits the company is going to accrue sometime down the line in future, right? So it is similar to a capital investment or a capital expenditure, but the accounting treatment of it forces these companies to account for them or recognize them as operating expenditure. Right now, this is an example I've given for a FMCG company. You can extend this example for another company which spends a lot on R&D, research and development, for example, right? Or companies which spend on their employee development, on their training expenses. All these companies are obviously they're spending not with an eye on your current year revenues, right? So these are not again expenses which they are doing only to grow their current year revenues. They are doing these expenses to grow their competitive advantage, right? And to grow their future cash flows, right? So again, what happens is, when these companies spend more on these items, they tend to have lower earnings, right? Because again, these are completely expensed out, so they enter your operating expense. So because they have lower earnings, they tend to show higher when you compare on a price to earnings ratio, right? Because your E in your price to earning, that is artificially lower, right? Even though they might be building a stronger business for tomorrow, right? When you compare it to comparable firms who are essentially not doing this kind of investments, right? So this slide, again, what we are trying to do is to show this, how this effect can magnify. So what we have taken is, two examples. We have shown an example of an FMCG company, Hindustan Unilever. Sure, many of you would be aware of this company or would have used their product, and Ultratech Cement, right? So this is a typical you can think of it as a typical brick and mortar business, which obviously has plants and invests in tangible assets, right? So while if you look at the trailing price to earning of HUL, it is more than twice that of Ultratech. So HUL would artificially look considerably overvalued if you just look at price to earnings, right? And we've actually shown this numbers here. So you can see that the price to earnings for HUL, just using the FY22 reported earnings and the price as of, we have assumed the price as of say in May 2023 would be around 71 times compared to 31 times for Ultratech, right? So just looking at price to earnings, HUL is around 2 times, or more than 2 times overvalued compared to an Ultratech, right? But when you look at the free cash flows, and we have shown you the how the price to free cash flow is computed. When you look at the price to free cash flow, you can see that the price to free cash flow for HUL is 77 times, right? Or 78 times, which is only 30% overvalued with respect to Ultratech. Now, how did this happen, right? So how did a company, which was looking overvalued by almost 2 times versus another company is now overvalued only 30%, right? What changed, right? The simple answer is the advertisement expenses. Just notice that line, right? So the advertisement and promotion expense for HUL is 9% of their sales in FY22. Right, versus only 2% of the sales for Ultratech. Again, no surprise there, right? Ultratech is a B2B business, right? HUL is a FMCG business, right? Which has, which does a lot of, spending on marketing expenses, advertisement, promotions, etc., to build their brand, right? So no surprise there. But that 9% is completely expensed out, and it, reduces your earning. So it artificially depresses your earnings for HUL, right? When you look at price to earnings, what happens is the ratio looks higher, right? Whereas when you now come to the capex item. The capex for HUL is much lower than Ultratech, right? And again, no surprises there, right? Ultratech is doing most of its spending on its tangible assets, right? HUL is doing most of its spending to build its brand, right? It's not, maybe it's it does have factories, I believe, but it's not, it doesn't have to invest that much in the factories compared to an Ultratech, right? So when you compare when you add up your advertisement expenses as a percentage of sales and capex as a percentage of sales, you see that the number is close to say 11% in FY22 for HUL, and roughly around, if I'm not wrong, around 12.7% for Ultratech, right? So this number is comparable, right? The only difference is, how they are being accounted in the earnings and how they are being accounted in the free cash flow. Free cash flow accounts for both advertisement expense as well as capex in a consistent fashion, right? So that's why free cash flow will never look artificially depressed, or or a price to free cash flow won't look, artificially overvalued or undervalued, versus using earnings or a price to earn, right? So the point here being that, a free cash flow measure, allows you to compare businesses with different business model in a more consistent way, right? Versus price to earn. And the reason is, like I, I repeated, I think, a couple of times, is that free cash flow includes all the expenses incurred by the company, right? So there is no way a company, you can exclude some expenses, or because essentially it includes all your free cash flow which is available to the company, which is available for distribution to debt and equity holders of the company, right? And finally, just to conclude, right, what are some of the other advantages? Because, like I said, free cash flows are affected because it's cash, right? It is less affected by accounting treatments. For example, earnings are easy to manipulate because they include major non-cash items like depreciation, amortization, which are basically accounting, which are based on accounting assumptions, right? So over what period you want to depreciate an asset, what is the useful life of an asset, what is the rate at which you depreciate an asset? It's completely up to the the CFO of the company, or the accounting followed by the company, and it's not also comparable across companies, right? And obviously there is leases and so many other construct which can make or give a wrong picture when you look at the earnings or the profit and loss statement of a company, right? Cash flows, therefore, are a sturdier measure of profitability as well as the true capital allocation skills of the company. And again, they are less manipulated by accounting assumptions, right? And this is for the same reason, I think we have repeated this in the past, that our forensic screen that employs a lot of this cash flow based metrics, right? Because the reliability of cash flows is much higher than earnings. Finally, we also wanted to show you this, this interesting statistic, because the market, the broader market, is generally, obsessed with, especially the mainstream media is obsessed with earnings. Typically when the earnings are, every quarter, you hear, earnings has, the company XYZ has beaten their earnings estimate or consensus estimate by, whatever. So what we also, this survey was done by CFA Institute. So this is what you see on this slide. So what it did is it took a survey of all the investment professionals, right? And they found that price to free cash flow, in fact, is the fourth most used valuation metric behind both price to earning, enterprise value to EBITDA, price to book, right? Which tells you that it's not very popular still, right? It is earnings, price to earnings, which is the most popular, right? So the risk here is, when you, build your strategy, or follow or choose stocks based on a metric which is heavily followed, right? You end up, making or buying similar kind of companies. And when everyone buys the same kind of companies, the share price goes up. So you access and trade on the same information, right? So there's a higher risk of being arbitraged away, right? Or earning less, less chance of realizing the returns going forward, by choosing or selecting companies basis price to earning versus say a price to free cash flow, simply because price to free cash flow is less popular versus some of the other metrics. So again, I think that's all from me today. But I just want to leave you with just summarizing all the thoughts, whatever we have discussed till now. I would just want to leave you with the first thought, which is that the reason why we use price to free cash flow is a very good indicator of not just the profitability of the company or the capital allocation skills of the management. It also tells you the quality of the earnings of the company. So it's a holistic measure, right? Secondly, like we said, like we discussed in one of the slides, it's much more well aligned with the interest of a long-term investor, right? At least with a 3+ year investing horizon, right? And last but not the least, it is a measure which is more comparable across companies with different business models, and also less subject to earnings manipulation or accounting manipulation, right? So with that, I would like to stop and hand it over to Alok for conducting the Q&A.
Yeah, thanks, Krishnan. This is really useful. So we already have a few interesting questions. But before we move on to the questions, I would like to reiterate that MeritorQ is a predefined portfolio which is available on small case platform for the ease of subscription and investments. You can visit this platform via our website, go to homepage, marcellus.in, click on Invest Now, select Investment Advisory Services, and then click on Small Case. I would also like to highlight that the recommended investment amount in this portfolio is rupees 2 lakhs. Rupees 10 lakhs. However, one can start with as low as rupees 2 lakhs and gradually scale up the portfolio. This portfolio is under the advisory format, so the execution needs to be done by the investor himself or herself, and at her own discretion, using their own trading and demat account. Now, moving to the first question, Krishnan, there are a couple of questions on the concerns that price to free cash flows would be lumpy in nature, maybe due to the life cycle of the company is in, or maybe the company might be doing a lot of capex because they see growth going forward. Then how do you justify using it as a better metric as compared to the price to earnings, which can be more stable in nature?
Correct. So it's a good question. So the short answer is we don't use the most recent year free cash flow. So we take into account the last the few years of the company. So it's the average over a particular look back period, right? And generally higher weightage is given to the most recent free cash flow. But the short answer is it is not the free cash flow of the company as of the most recent reporting date, right? Which can be lumpy. You're right? Because both working capital as well as capex, or if a company does an acquisition, those can also be lumpy, right? So cash expenses as such, they tend to be extremely lumpy. So we smooth it out by averaging it over a particular look back period, right? So the if for example the question is if what happens if a company has negative free cash flow but it has good growth prospects, right? Now look, I mean in MeritorQ, I think I've repeated this in the past. The rules, the strategy is based on factuals, right? You might have a strategy, which is looking at again turnaround stories, right? Or a strategy, which is investing basis some judgment or some rosy forecast. But here in MeritorQ, we avoid that, right? This is a rules-based strategy. We avoid emotions and judgment as much as possible, and that's the reason we look at the trailing numbers. But again, like I said, it's averaged. Yes, I mean, we'll miss out on turnaround stories, but we're happy to miss out on those, right? Because like I said, I mean, there are plenty of other companies which generate sustainable cash flows. And generally, the evidence is stronger in favor of companies which have a track record of generating free cash flow in the past, that they will generate good returns in the future.
Right. Thanks for this. A follow-up question on say consistent profitability and selection of companies. So somebody is asking that if price to free cash flow is so relevant, then why don't we skip the initial steps of forensic, low leverage, consistent profitability and directly choose the companies which have the say highest price to free cash flow? So will that not help?
Yeah, so because I think this slide explains this really well. For example, if you just exclude all those steps, right? You didn't do any of the screening steps, or you are not looking at profitability at all. So this is what this is the scenario we are looking at, right? So we would end up with all stocks in quintile 5, right, which is your most cheapest quintile in terms of price to free cash flow. Now, when you compare the returns of this quintile, you can see that this returns are slightly lower than quintile 5. But what also happens is we have not shown you the risk-adjusted number. The risk-adjusted number, which is your returns that you're earning for every unit of risk, that's much higher for quintile 4, right? And also quintile 4 is more profitable, has more profitable companies. It has lower leverage, right? This is the reason you should be focusing on quintile 4, right? Because quintile 5 has these value traps, right? Number one. Number two, even though I didn't mention it, there could be a number of cyclical companies, right? Which could be, because their businesses are like that, they go through, the share prices themselves would go through a seesaw, right? So during a particular rebalance, you would see some of these companies are either are deeply undervalued, right? And just picking up these companies, just because of a transitory movement in their the cyclicality, or the movement in commodity prices, is not in good interest of the investors, right? So that is the reason, again, basis those screening steps where we are controlling for looking for companies with clean accounts, with low leverage, consistent profitability, and also finally selecting companies which are both profitable and undervalued. We avoid the quintile 5 and we focus on companies in quintile 4.
Okay, got it. So your example around Hindustan Unilever and Ultratech maybe tells us that price to free cash flow can help us identify growth companies, maybe at reasonable valuations. But if we look at PE, then probably we might feel that these companies are overvalued, these companies are expensive, and we might miss out in terms of investing in these kind of companies. Is this the understanding right?
Correct, absolutely, right. So if you had just used price to earning, so what would have happened is HUL would be either in quintile 1 or 2, which is the most expensive, right? But if you had used price to free cash flow, HUL will probably be in quintile 4 or quintile 5, right, which is profitable, undervalued actually versus its free cash flow generation.
Okay, got it. So question around rebalancing. Why do we do rebalancing only twice a year, April and October? Because in case there's a huge rally in the markets, then some of the companies might become drastically overvalued. So will it not be favorable if we do rebalancing more often?
Yeah, actually, we struggled with this, when we were, building this strategy. But what we found out is, see, first of all, we want to avoid discretionary calls in a strategy like this, right? Because trust me, again, if it's okay to believe, be very confident that human beings are really good at making discretionary calls, but actually, evidence is that we are not very good, right, at making discretionary calls, right? So that is the reason primarily we stuck with this fixed calendar rebalancing. So we just rebalance for all investors as of the first trading date of April and October, right? Now coming to why we decided on a 6-month rebalancing frequency, the simple reason is to keep the churn under control, while at the same time giving enough time for the stocks which have undervalued stocks to revert to their fair value, or their to mean revert to their fair value, right? So 6 months is what we found basis, the work we did, that, that is the ideal, rebalancing frequency, which allows you to keep your churn under control while at the same time, realize the returns, right, from this mean reversion. So that's the reason it's not that, again, we'll get into some of these details on, this interdependence of turnover and this rebalancing frequency in maybe one of the later webinars. But, the short answer is, this is the rebalancing frequency was chosen to strike the right balance between the cost and the benefit, which is your churn, which is a cost for investors, and the returns, which is the benefit, right? So,
right. So one interesting question, that if we feel that price to free cash flow is a better earnings, better metric to identify the companies, along with, say, consistent profitability and low leverage, why is the rest of the market so obsessed about PE? Any thoughts on that?
I think because earnings are, generally, so management, so management, when I say management, essentially the finance department of all companies, they basically, prepare in India, earnings are prepared first, right? And earnings is what is released first to the investors, right? Cash flows, I don't think many Indian companies report cash flows quarterly, but earnings are, definitely reported quarterly, right? Because earnings, like I said, because, there are, you can, the management has more levers to control the earnings, right? Window dress the earnings if they want, manipulate it if they want, to show whatever they want to show in a particular quarter. It's probably much more preferred by them, right? And because, nearly all companies then show earnings, the financial media and everyone else has got used to, using earnings, not only for valuation, but also for, nearly everything else, looking at, the quality of the business of the company. But whereas what we have observed is, it is the free cash flow, which is much more important, right? It is harder to find. And like I said, it's much less popular, but finally, when, when we end up, buying these businesses or buying these companies, it is free cash flow which matters.
Right. So one most commonly asked questions nowadays is, markets are at all-time high. So whether one should look at investing right now or should wait for the markets to correct a bit, cool down a bit. What's your thoughts?
Look, I mean, generally we don't try to time markets, whether it's this in MeritorQ or in any other Marcellus strategy. Markets can go up and down. What we recommend investors is to, keep at least a 3 to 5 year horizon when you're investing in equities. Again, peaks and troughs in market is a normal part of, investing in, markets, and, it's a part of investing in equities. Right. And specifically coming to MeritorQ, what we have shown you is, if you have an investment horizon of at least 3 years, right? And we have shown this in the past that in at least in history, MeritorQ has never underperformed the benchmark in any 3 year period, throughout its history, right? So rest assured that, again, when in terms of, at least we will not be able to exactly time the market, but rest assured that we will, strategy, which we have, we will at least, try to do as much for the investors over a long-term horizon, right? Whether it's 3 years or 5 years.
Okay. So one of the attendees is asking that free cash flow will be lower for high growth companies, because they need to consistently reinvest for future growth, versus a company which doesn't need too much investment and might distribute dividend. So do you think which one of these companies can deliver better shareholder returns?
Actually, let me correct that a bit. Look, I mean, it's company investing is not necessarily bad, right? So as long as the company is profitable, it's able to sustain its capex, right? We should still get those kind of companies. We should still be able to get growth companies, right? And remember, we are looking at the free cash flow generated by the whole company, right? So this is the free cash flow which is available to the debt and equity holders, right? So that free cash flow can either be used to pay out the interest or the pay down the debt, or it can be used to pay out dividends, right? Now, because we are screening for debt to, again, we are looking for companies with very low debt to equity, right? So nearly almost all these companies in MeritorQ, what happens is, this free cash flow, there's no, need for these companies to distribute to anything to do with debt, right? Either pay interest or debt. So either these companies can pay dividends, which is good for investors, right? Why do we mind dividends, right? Or the companies reinvest in their own business, which is what we have seen for most companies in MeritorQ. So when companies reinvest in their own business, so if you assume a reinvestment rate of 75%, right? On again, like we are choosing profitable companies only. So let's take a ROCE of 25%, right? So 25% ROCE, and you're reinvesting 75% of that. Even if you're paying 25% of your other cash flows as dividends, you're going to compound your earnings or your free cash flows by at least 18 to 19%, right? So which is not bad, right? So all I'm saying is the steps in our checklist itself ensures that the kind of companies we are getting will be, for most parts, be diverting most of their cash flows to reinvesting, and when they reinvest, that itself will propel their future growth, right? So in a way, we are accounting for the future growth or companies with good growth potential in future.
Right, got it. So one last question. One attendee says that with the markets coming out of a 18-month bear market, he believes that growth stocks will do better as compared to value. So how do you think Meritor strategy would play out during, say, the bull market as what the expectation of this attendee is?
Yeah, so there are various definitions of bull market, but let's be. So I just want to clarify one point, right? We will never invest in companies, for example, which have shady corporate governance, right? So for whatever reasons, if you define bull market as a phase where shares of all such companies go up, right, which is what we have seen in previous cycles, then maybe we will underperform, right? And but remember that this rally cannot sustain, right? So even though you're going through these phases, and we might lose out temporarily over a longer time period, at least 3 to 5 years, we should still come out trumps, right? Again, and that's what we have seen. That's why I keep on going back to this point that when you invest generally in equities, and even generally in a strategy like MeritorQ, a minimum investment horizon of 3 years is recommended, right? So that you're able to kind of navigate this market cycles, and also the change in styles, right? The preferences of investors. So someone in some phases, investors might prefer value stocks, someone might prefer growth stocks. You'll go through these phases, right? But when you invest over longer term, what you would see is a good strategy, right? With a good balanced strategy, which picks up good companies, and which basis all the steps we have highlighted, we do this in a disciplined way, right? In keeping our emotions at bay, that should come out, that should work out well for investors.
Right. One final question. One attendee is asking about how do we go about allocating the weightages to the companies in the portfolio?
So this is the allocation is decided basis the price to free cash flow again, right? So basis again the definition we highlighted in one of the slides. So the more undervalued the company is, basis price to free cash flow. So lower the price to free cash flow, higher is the allocation to the company in the final portfolio, and vice versa.
Yeah, thanks, Krishnan. This was really insightful. I think we have covered all the questions. So if anybody has any further questions, they can write to us on help.ia at marcellus.in. And if they wish to invest in this product, they can visit marcellus.smallcase.in and follow the steps there, and they'll be able to invest in this portfolio. With this, we come to the close of today's webinar. We hope we were able to get you some insights around the importance of free cash flows in any business. And thank you so much for attending today's session. Till next time, thank you and have a great evening.
Thank you.